Hi, this is Joe Rabel with Invest Like a Pro. Wanted to follow up on the S&P chart and get into a little bit more detail on certain ways to look at the trends. Before I go into that, I have posted a link underneath in the comment area. I had a question from one of the subscribers about entry points and different entries, and so I decided to post a link to the website investlikeapro.us and an article that I posted in there today that gives a little bit better explanation, I think, as to how you would use different entry points that I have in my book, Invest Like a Pro. So take a look at that. It might be helpful. I'm going to try and add some of these thoughts into the next few videos as well on the trading patterns. I'm going to talk about the S&P, and then I'm going to go into a specific trade setup that took place over the course of the last week or two that I thought was a really good example. Kind of meets a lot of the criteria that we're looking for. So I've got a monthly chart on the S&P on the left side here and a weekly chart on the right. What looks different is that what I've done is I've taken the 40 MA off the charts. I did that specifically for this. I'm going to put it back on. In fact, later on, I'm going to have it on the 40 for the other trade. But I wanted to show you something because I think it's real important. The 18 on each time frame does a really good job of telling you what the trend is. This is just a simple moving average. 18 MA for each time frame. So I'm on a monthly here, and you can see this is, I actually made it really thick. This line is basically flat right now. It's been rising for a pretty long time, several years, and now we've sort of flattened out. I would say it probably has a small negative bias on the monthly chart, just based on the fact that price is below it, and it does have a slightly downward slope to it, but it's really more flat, and I would consider this time frame probably a little bit more neutral with a slightly bearish or negative bias. If I go to the weekly on the right, it becomes pretty clear. You were in an uptrend for most of 2019, and then you had a really hard down move. Now the 18 is declining, but notice how far away we got from that line. I think it's real important to take that into the equation because it tells you when you're getting really far away from a specific 18 MA, it just tells you have pullback risk, or in this case, rally risk against you. So you just have to be really careful if something is trending and it gets too far away from 18 on any specific time frame. You should expect some form of a snapback, and that it's a really good method. It's kind of like when it gets too far away, it pulls it back like a leash. So you want to be on the lookout for that. I have been talking about the fib levels over the last, 3 videos, and I think it's important to recognize that the fib levels become incredibly helpful when we have a lot of volatility. When there's significant amount of volatility in the market, they become useful because the moving averages take a little bit of time to catch up. There's lag in indicators. So when you're focused on price, you want to be, during really volatile times, you want to be focused on price. And when things start to get really, really volatile, you got to be a little bit more careful about focusing on moving averages and MACD and ADX, because when volatility expands, those will lag. Now, what you can do to make up for that is to go down to a smaller time frame. So I've been doing that. I showed some trades in the spiders on a few videos going back a month or two. On the way down, on this leg to the downside, some of the short, we did some put trades that worked out very well. I was going down to a 2-minute chart on some of those because the volatility is just so big. The size of the bars were huge, so you really had to do that in order to really be able to play. So go back through those videos if you get a chance. I think it'll make a little bit more sense to you. But I wanted to show, so we're basically have a slightly downward bias on the monthly chart. We have a downward bias on the weekly, but we're oversold, and we're kind of working off that oversold condition. Now, if I go here and look at the daily, something interesting took place, and I mentioned this kind of the last time when we made a high here and then pulled back and made a higher high, and I showed it on the hourly chart. The hourly trend had basically turned back to the upside. But what it was telling us is that the 18 MA on the daily chart was turning back to the upside. And that tells me that this time frame on a daily chart has a slightly upward bias now. Now, notice the difference between the weekly and the daily. The daily chart is above a rising, but it's extended away. You're pretty far away. There's some pullback risk on a daily chart. We could pull in a little bit and still be in an uptrend on this time frame. So I think it's the reason why I wanted to bring this up. I just think it's important to recognize that right now we're in a period where the monthly is, I would consider neutral, maybe slightly bearish. The weekly is bearish. The daily is bullish. And best trades, your best opportunities are when the monthly, weekly, and daily are all in confluence. They're all pointing, they're all kind of aligned in the same direction. And you're getting in pretty close to all those moving averages. If there's not a lot of pullback risk on the higher time frame. So I just thought this was a good way. We've only had a day of trading since the last time I did a video. So there's not a huge amount of change. I'm going to show you the hourly. The last time we spoke, I said what you could do is draw on a trend line a little bit tighter, like this. And what we're looking for is a down move and a break of the 18, which we're basically doing. And now it's starting to rally back up. I personally would like to have seen a little bit stronger decline and then get a little bit better rally, a little bit more definitive in the way it's playing out. But I think it really kind of depends how you want to look at it. If you don't want to miss a market move, I think this qualifies. I think we have enough action around the 50% retracement to be able to consider doing this trade. So if you notice, the MACD lines are pointing down right now, despite the fact that we're getting a minor little rally. So I think what you could do, you could either look at this minor little uptrend line, which on a 10-minute chart is essentially, you know, this line right here. And a break of that line would give you a trigger and you'd put a stop in at this level. Now, you have to understand when you're going down to a really tiny time frame like this, in this situation where the daily trend is still up, you're taking a little bit more risk. If you do anything, I want to show you something on this time frame. If you do a move, this move here, that is a trend line really for the move right now. So anything you take, any kind of short trade you take right now is going against the daily trend, and until you break this trend line, you're taking on a little bit more risk, just because you've got some counter trend movement taking place in another time frame. So I wanted you to be aware of that. I think the potential is there, and because we're right at the 50% retracement, I don't have a problem taking this type of trade. I mean, you could take you've got a 1-2 in place. You could wait for the 3 to be a little bit more conservative, and then take some profits. Maybe not the whole thing, but take some partial profits as we come down towards the trend line. And then if it turns around against you, it's not like you're going to lose a lot of money. You're probably going to make a little bit if you take some partial profits here. And if it ends up breaking this trend line and starting something bigger to the downside, you can really participate. So I view that as a kind of a good way, or I think a good thought process right now. The other thing that you could look at, if you wanted to be a little bit more conservative, is wait for this trend line break and then look for a retracement back up. That would be kind of like the more conservative methodology to go after this move that's kind of, to be a little bit more confirmed that we're getting a move back in line with that weekly trend. We still are really stretched away on the weekly chart. So, I mean, we got to be careful. We could easily come down, find support on the daily, and make another move to the upside. I know a lot of people are calling for a big crash and for this to drop and go crazy to the downside, but that was a pretty climatic low down there. A lot of people got very bearish. I watched the sentiment numbers, and it was a pretty bearish number down there. So, I'm not sure. Frankly, and I don't need to know. That's the big thing. I don't think you need to know. I think what you need to do is look for key levels and see if we get any kind of trigger levels to develop or trigger mechanisms to kick in. And watch these 18 MAs. I think they're going to be very, very helpful. I'm going to pull up another chart. The stock is Chewy. I'm going to pull up a daily on the left side. On the right side, I'm going to put an hourly up. And I'm going to switch this with the 18 and the 40. I want to show the ADX because it's real important. This just shows there's so much volatility in a lot of these stocks that the ADX is just not going to be as helpful as it usually is. When you get huge overruns and big spikes and a lot of tails, the ADX is going to lag dramatically, and it might tell you not to do a trade when you really ought to be looking to do it. So right now, I would probably minimize a little bit of the importance of ADX just in the near term until things settle down a little bit and we get a little bit less volatility taking place. Because if you look at this trade on a daily chart, you made a really strong and powerful move to the upside here, and then had a really nice pullback to the 18 MA. Now, at that point, we've pulled back. I want to go and look at the hourly chart, and I'm looking for this opposing trend. And I've mentioned a few times about going in the zone and then coming out of the zone. And what I mean by that is you go in the zone between the 18 MA and the 40 MA, and they're going in the opposite direction as the trend time frame. This is the time frame here, the daily chart. Is the time frame we want to trade. We know the trend is up and we've got a strong move to the upside and then we get a pullback. Now, after we get the pullback, we're actually looking for the counter trend to be developing on the lower time frame, and that's what's happening right now. The 18 crosses below the 40 and it looks like a bearish trend on the hourly. That's what we want. And we want it to go inside this zone and then come out and act like a sell signal, act like it's going down. But what we're looking for is for it to fail. So it comes down, it actually tests that low. And if you don't break this low, it's a very bullish sign, actually, that you're probably going back in line with the daily trend. Another way to confirm this is to draw in your trend line. You can see the trend line and the 18 were basically the same. You came up and popped through, and then when you came down and tested, that was the 2. So 1 is breaking the trend line, 2 is testing the low, and then 3 is really taking out this peak up here. And as I've said in prior videos, I don't know that I really want to wait for that in most cases. You could wait or you could use the MACD cross right here. In this case, if you zero in on what took place, by the time this closed the day, and we had confirmation that you had a cross of the MACD. It actually didn't have a very good bar. It closed right at the low of the day, and it wasn't a wide range bar. There wasn't real strength showing up. I probably would not have done that trade based on that cross. But what ended up happening is you had 1 lower high, 2 lower highs, 3 lower highs, but the MACD held. This qualifies as a pinch play, and at that point, you could have gotten in at this point right here and used a stop right underneath there, taking out this bar and using the stop below these 2 bars as your stop point. I think that's a very good approach. The other thing that I think as a fail-safe that you can do is go down one more time frame. And if you look at what took place on the lower time frame, we actually, at that point in time, we broke the downtrend line. And then it came down and tested. And then when it took out this peak right here on a 10-minute chart, you had a 1, 2, 3 change in trend to the upside. So you could have gotten long at 34, which wasn't much. I mean, it was a little bit different than the pinch play entry, which is always going to be a really tight entry. But you could have had your stop in the same place right down here. And it would have been a pretty good entry. And just to make sure we're all clear, the target area for this trade is right up around this 30, well, let's be a little bit on the conservative side, call it 38, 38 and a half. Now, if we're getting in at 34 conservatively, and we've got to stop in at, say, 32.80, 32.70, and room all the way up to 38, we're definitely got our 3-to-1 potential. And that's really what I'm trying to find on these trades. That is the goal. So anyway, I hope this was helpful. Please post any comments or any questions that you have. Hit the subscribe button, and we'll talk to you soon.